Good afternoon, Jenny and Scott. Today I'll be talking to you about your superannuation and retirement. Jenny and Scott, your idea for your retirement is to meet your comfortable ASFA standard. Your retirement income was calculated for the couple in order to create recommendations for how you can maximise your future income in retirement. Your retirement planner was made up of the following information that was inputted. Your age was 63, you have an income of 85,000 and a desired retirement age of 66. You are a couple, your super is 35,000, your employee contributions is 15.4% and you do not have any additional contributions. Changes to your income that affect super, you have none. About your other partner. You are 62 years of age, your income is $26,000, and you have a desired retirement age of 65. You have a super balance of $100,000, you have 9.5% in super contributions, and you do not make any additional contributions. Jenny and Scott, as per the retirement planner on MoneySmart that I have predicted for you, I have calculated for you, it says that you will receive $58,960 in annual income. In comparison to the ASFA retirement standards, the modest ASFA retirement standard is $40,000 and $560. The comfortable ASFA standard is $62,269. Scott and Jenny, you are in the modest bracket. You want to be in the comfortable bracket. In order to get you to the comfortable bracket, I will be discussing a series of strategies that you can use to increase your retirement savings, which will be downsizing, recontribution, reverse mortgages, and salary sacrifice. The first one, recontribution and bring forward rule. Eligibility. Your super balance will need to be under $1.4 million to reinvest up to $300,000. Must be able to make non-concessional contributions and must have not made non-concessional contributions. Scott and Jenny, you must meet a condition of release and are over 45 but under 65, which you both are. Also, you can recontribute $25,000 of concessional and $300,000 of non-concessional. Jenny should make the full concessional contribution and Scott should implement the bring forward rule and take $300,000 to recontribute. The bring forward rule. This means that the amount taxable on Scott's super account is reduced from $300,000 to $100,000. 15% of $300,000 is $45,000 and 15% of $50,000 is $7,500. Scott is gaining $44,250. Downsizing. Scott and Jenny should downsize. You should downsize from your $1.2 million home. This would give approximately $500,000 in income rather than assets. You can use this surplus to put a downsizer contribution into your super accounts. Eligibility is owning a home for over 10 years to be able to contribute up to $300,000 from the sale to super. Scott could also sell the property he is 50-50 invested in that is worth $100,000, which Jenny could concessionally contribute up to $75,000. Reverse mortgage, a strategy that allows homeowners to draw on their home equity, can remain in the property, 1% over 15% for each year over 60. 18% of home value is $216,000, could go towards recontributions or keep in savings account for travel money and expenditure. Spouse split. Spouse contributions. You can split employer contributions of up to 85%, which is 85% of $25,000, which is $21,250. You must be married and under 65, which you both are. The tax offset available for lower income spouse. Jenny only earns $26,000 per annum. Scott could contribute to her super. Salary sacrifice. Making extra concessional contributions is tax effective if you earn more than $37,000 per year. a maximum of $25,000 per annum. Scott earns over $35,000, unlike Jenny. He could contribute $25,000 per year. Recontribution / bring forward rule. Advantages and disadvantages. No contributions tax. The non-concessional $100,000 cap is higher than the concessional contribution. If under 65, can bring forward 2 years of the non-concessional contribution cap, which is $300,000 over 3 years. Non-concessional contributions are tax-free, even lump sums / death withdrawals. Age is not a factor. Earnings received in a super are taxed 15%, CGT reduced to 10% within super. If asset owned over a year, once an account-based pension, tax-free. These tax concessions increase your wealth. Disadvantages. No tax deductions for non-concessional contributions to super, won't reduce personal assessable income for tax purposes. Conditions need to be met such as age and caps. Breaches mean excess tax and charges. Downsizing and analyze. ASTA discovered downsizing to more affordable homes and locations can save up to $650,000. Homeowners aged 65 plus can contribute this surplus from downsizing to their super. Each person can give up to $300,000, $600,000 in total. Disadvantages. High stamp duty fees, family home free from asset test, but any money from downsizing is not. Miss out on certain age pension payments. Have to give up family home where they are settled. Have to downgrade, hard to find suitable property. Reverse mortgage. Increases income in retirement. You still own your home and reside there. Lump sum to cover expenses. Helps when organising aged care. Disadvantages. Debt increases. Interest and fees are added onto loan. The interest rate is higher than normal. Can affect eligibility regarding age pension, aged care. Not good if personal savings and assets aren't high. Salary sacrifice. Reduces personal income tax, increases retirement income, reduces investment earnings tax, creating large savings unlike investing normally. Can contribute to insurances. Disadvantages of this are higher earnings that can have additional contributions tax, can't access super contributions until release, fees included, contribution cap. If a partner were to die, beneficiary's sum is taxed. Spouse split pros and cons. Low rate threshold available if younger than 60. Provides low income spouse with super. Can cover insurance fees for receiver. Can provide superannuation benefits early if one spouse is older or settling position if younger. Disadvantages. Not tax free, not allowed to contribute large sums. Uses most of concessional contributions and can't implement other strategies. Projected income with recommendations. Bring forward. Scott and Jenny would have an extra $44,250 in income from their super by implementing this strategy. Jenny could also recontribute $25,000, which would be tax-free, meaning she would have $75,000 tax-free rather than $50,000. So their retirement income would increase by $68,500, which is over the comfortable ASFA standard. Downsizing. Scott and Jenny have lived in their home for 15 years, so you are eligible to contribute up to $300,000. Your retirement income would increase to $67,613, which exceeds your goals. You could then travel and live comfortably. This exceeds your current situation. Reverse mortgage. $216,000, 18%, 1% over 15% for every year over of Scott and Jenny's home value. Could contribute $25,000 each year for 2 years into their super accounts to increase their retirement income to $62,131, or they could invest the money to travel or use for expenses. Spouse split salary sacrifice. $21,250 into Jenny's account for 2 years, tax offset. This increases your retirement income to $60,514, which increases your retirement income but not to the comfortable standard. Similarly, salary sacrifice only effective for Scott to contribute $25,000 per annum. Retirement increases to $60,562. As you can see in this comparison chart, downsizing and bring forward method / recontribution are the highest earners. All recommendations increase the retirement income from $58,960 to over $60K. The biggest increase is by using the bring forward rule, recontribution, and then downsizing, which meet the ASFA comfortable standard. The other recommendations increase retirement income from current situation, but does not fully meet your current goals that you want to achieve in retirement. Alternative strategies. Employment termination payments was considered but disregarded, as Scott earns a significant amount from his job that contributes 15.4% to his super and increases savings. A lump sum would have been paid to them, however, it is not tax-free and can't be rolled into super. Insurance bonds was also considered, but both Scott and Jenny have shares that they receive dividends on. To recommend they invest in more bonds is not as tax effective as the other strategies, such as downsizing, recontribution, and bring forward. Deferred annuities was considered, as Scott could invest in life insurance so that if he were to die, Jenny would receive more income as well as their super. It was disregarded because I feel this money would not yield higher returns than the other strategies. Jenny and Scott are similarly aged and still under 65. In conclusion, Scott and Jenny can meet the comfortable ASFA standard by implementing the bring forward rule / recontributions. Their goals can also be met through downsizing, although they may not be comfortable relocating. There are other strategies such as reverse mortgage, salary sacrifice, and spouse splitting that can increase their income but just miss out on the comfortable standard. Thank you for listening.